The CNIB National Youth Council presents Let's Talk Money. Part 3, Investing 101.
Well, thank you everybody for having me. I'm really excited to be a part of the Let's Talk Money series. And like you've heard today, we're going to talk a little bit about investing. Before we kind of dive into that, my name's Chris. I'm part of the portfolio management team here at Wealthsimple. And for those of you who don't know, Wealthsimple, we manage money in a number of different ways. And money is very important in life. We all want it. We all want more of it. How do we manage it? But it's also one of those things that we don't really talk about a lot. And we believe the more we can talk about money and what to do with it, how to get more in a responsible way, the more successful we'll all be. And at Wealthsimple, our mission is to try and help everyone be a smarter, more thoughtful investor. And we actually help people by managing money on their behalf or for them. We set up very broadly diversified portfolios. We rebalance them. We stay within the parameters our clients tell us to, and we do it all for a very low cost. And I'm going to talk a little bit more about that later. But today I'm going to go over 5 simple rules that we believe all investors should be thinking about, but also more importantly, 5 rules to encourage people to start investing and to start investing in a really thoughtful kind of way. And ask questions along the way. I'm happy to pause at any time and elaborate more on a topic. Also, if there's something of interest to you, I'm always happy to kind of take anything offline as well later in the week or at any kind of convenient time in the future. Because today's goal is to provide you with information about investing to really help try and position you for success. So with our 5 simple rules with investing, we want to encourage everybody to focus on what you can control. And that's going to make a little bit more sense as we go through the presentation. And once you focus on what you can control, then you can take a really long-term view. Everything else becomes noise, and you're going to be really well positioned. So let's get started. I'm sorry, I'm looking the other way just because my slide is actually over here, and I don't know how to go forward. Hold on. One moment.
You might be able to do it with your keyboard with the next arrow or the up arrow, one of the two.
Yeah, it seems to not be working, but let me just get out of that. Sorry, guys. This is why we do these. Chris, see if it works first, right? Okay.
No worries. We're used to it with this day and age.
Yeah, I thought I was getting good at this by now. Here we go. Okay. But so Wealthsimple, we've grown significantly over the last 7 years since we launched. We have over 1.5 million ecosystem users, which just means people across all of our Wealthsimple platforms using us. That's primarily Canada, the US, and the UK. We manage well over $10 billion in assets. So rule number 1, and on this, I'm just showing a slide that with the title, Get Started with a Clock on it. And well, first of all, is anybody here an investor? Maybe just like put a thumbs up, or you can say yes or something. I'd love to know if anybody here is currently investing.
Yeah. Yes, I am.
Yeah.
Yes, I am.
Awesome. Okay. So it's great to see that some people are already involved. I saw Chantel there. And getting started may be the most important point that we covered today. Start early, start today, right now. There's no magic number to begin. $1, $10,000, or $1 million. The key is starting as soon as possible. And why? The answer is compound interest. Einstein said, well, sorry, this may not be true. We don't know if Albert Einstein actually said this, but we believe it to be true, that compound interest is the 8th wonder of the world and mankind's greatest creation. And when a guy like Einstein says something, we tend to listen. And here's why compound interest is the single most important concept in investing. Think of those little snowballs kids make. They line them up at the top of the hill and roll them down. Inch by inch, that small snowball is starting to pick up more and more and more snow. Eventually, those kids have enormous snowballs to play with. Another way to think of it is earning interest on the interest you've earned in the past, and then doing that again and again and again. And eventually, the annual interest you're earning becomes more than the initial investment you ever made. So here's a quick example. There's two friends, one's 30 years old, the other is 40. They each begin putting away $5,000 a year until they retire at age 65. By the time they retire, the 30-year-old has invested $175,000. The 40-year-old will have $125,000. So there's a $50,000 difference in the amount of money they're going to have in retirement. Now, when we think about retirement, that's not really an instrumental amount of money to change the way somebody's going to live throughout the retirement. But if we add compound interest, let's take a look and see how kind of the experience is for our two friends, or what experience they have. So the same friends investing $5,000 a year, each earning a 5% rate of return. So each year earning 5% on the money that they have invested. Our 30-year-old friend has almost $500,000 more than their 40-year-old friend. And that is a life-changing amount of money to miss out on for only missing 10 years of investing. So that $50,000 essentially turned into $500,000 by earning 5% a year. And as time goes on, it becomes a more and more impactful, or it has more impact on your retirement and on the amount of money you're able to earn. Now, if you're the older friend, don't panic. Again, we want to focus on what we can control. And the key is really starting as soon as possible. Okay, so rule number 2 on my slide here, we've got a gold money bag with the title, Don't Pick Stocks. Now, I don't know where it began, but at some point, the idea of thoughtful investing was based off of sitting behind a dozen computer screens, analyzing charts and data and company earnings. Now, we don't think the number of monitors you use translates into greater investment success. Now, here's a story. It's a little more anecdotal, but nonetheless, a great story. It involves a well-known university, a monkey, a pack of darts, and a stock picker. In 1973, the Princeton University professor of economics claimed that a monkey throwing darts at a list of stock symbols could rival the efforts of professional stock pickers. Now, I can imagine you know where I'm going with this. During this experiment, the dart throwing monkey has not just rivaled the experts, but actually beat them. Now, this story is not meant to discourage anybody from trying to invest, because research shows that passive investing, which is the practice of investing in big chunks of the stock market or different investments, beats the active traders who are trying to pick those individual stocks that are going to beat the rest. That passive investing wins 80% of the time. And every year, people pay professional money managers, these expert stock pickers, to build mutual funds with only the companies and the investments that are going to do better than the rest. Yet after fees, very few of these professionals are actually able to beat the market index at all. Beating the market is very hard to do. And it's one of the reasons there's only one Warren Buffett. I'm sure everybody's heard of him. One of the greatest investors of all time. If it were easier, we'd have a lot more billionaires who earn their fortune from making good investments rather than collecting fees from their clients. I'm going to pause there and just see if we have any questions.
Yes, my name is Chantal. What about index funding?
Chantal, your question is about index funds?
Yeah, because then you don't choose, you kind of take a wide range of different stock.
Absolutely, Chantal. And you and I are on the exact same page. When you say index funds, we refer to that as passive investing. So buying the stock market as a whole. Now, in a couple of points, I'm going to get into fees and funds, because there's a couple of different ways that you can buy index funds or buy index investments, I'll call them. One is through owning a fund, and the other is through, say, an ETF or kind of a broad market ETF. But you're absolutely right, and that you're actually describing our approach to investing.
Excellent.
Okay. So rule number 3, the title of the slide is keep costs low. And we've got one of our favorites logos here, which is a gold elephant on the slide. So there's many decisions you make in life. And a lot of them have a direct relationship between what you pay and what you get, or you get what you pay for. So you think about cars or vacations, homes, real tangible things. The more you pay, usually the higher quality that thing is going to be. But there's one really important part of our lives which this does not hold true, and that's with investment advice. And this point is particularly important for everyone in this room. I'm assuming everybody lives in Canada, but Canadians pay the highest investment management fees of any developed nation around the world. The average Canadian is paying between 2 and 2.5% to invest in an equity mutual fund, a fund which is comprised of things like stocks that you can buy. That's what these professional money managers put together to try and beat the market. And they charge very high fees to do that. Now, meanwhile, our neighbors to the south in the United States are paying 1/3 of what we pay for the same advice. And, we think this is a remarkable difference. We're paying 2 to 2.5%. They're paying 0.8% for that same investment advice. Now, keeping your costs low is important for a couple of reasons. Number one, think back to rule number 2 we had. Over 80% of professional stock pickers underperform the market. Those are those mutual fund managers. Yet in many cases, we're being asked to pay this premium for that underperformance. And also rule number 1, we touched on the benefits of starting early and mankind's greatest creation, compound interest. Well, the same holds true if you apply that to cost. A lot of people shrug off that 1 and 1.5% difference between Canada and the US, thinking that 1% doesn't sound like a lot of money. But how much does 1.5% translate to over our investing lives? So we'll use another example. 2 people, same age, same approach, each investing $5,000 a year at the same time with the same rate of return on their investment. The difference is one lives in Canada, one lives in the US. So our Canadian friend is paying 2.35%. Our US friend is paying 0.82%. Come time for retirement, our friend in the US has $120,000 more to fund their retirement, all because of the cost of advice. Now, changing nothing in your portfolio other than cost has a remarkable difference on your long-term success in building wealth. And this seems fairly obvious with a quick example like this. So why don't more Canadians pay attention? And the reality is fees are often a hidden cost, not widely understood. And a good general rule of thumb for people starting to invest is keeping your all-in costs below 1%. And Chantel, just to kind of add on your question, buying an investment that can track the index, the most common ways are through an ETF, which is a true passive investment designed or by design to track an index or broad market exposure, just like you suggested. Now, the reality is a lot of mutual funds track indexes, and they do it for a variety of reasons. But the problem is they're charging 2.5% to do that. So right out of the gate, they have a 2.5% handicap, and most likely, or more often than not, over time, end up underperforming the market they're participating in by the amount of their fee. So there's a direct correlation to the cost and performance. the keyboard is working to move the slides, Caleb. Thank you.
Great.
Rule number 4, the title is Diversify. Investing in stocks and bonds comes with risk. There's no doubt. But this is partially why it can be pretty lucrative. And you've probably heard it's good to have a diversified portfolio. And it's not really just a neat idea. The concept actually won a Nobel Prize. And a guy named Harry Markowitz discovered the relationship between risk and return and how you can reduce your risk without giving up return. And this is called diversification, which is really another way of saying don't put all your eggs in one basket. Now, thoughtful investing includes spreading your eggs across many different baskets, which you guys have probably heard before. Now, let's replace your eggs with your money. And let's replace the baskets with industries and countries from all over the world. Doing that, you can protect yourselves from the ups and downs of any one egg or any one basket within your portfolio. If the rest stay intact, it's not going to have an instrumental impact on your overall performance. And the reality is it's very difficult, or really no managers can do with any sort of consistency predict which assets or investments are going to do the best one year. 1 year it's going to be the US stock market, the next maybe emerging markets, and the US is at the bottom of the list. And then the next year is real estate, then gold, then bonds. There's a huge fluctuation in which assets perform the best on any given year, which is why having a broad diversification or having your eggs across all of those baskets gives you exposure to all of the different asset classes, but it also protects you from the worst case scenario where if all of your eggs are in one basket and something happens to that basket, it's really going to have a major impact on your retirement and your investment portfolio. So this brings us to the final rule, which is rule number 5. Tune out the noise. The title is Tune Out the Noise, and there's a megaphone on the slide. And this is also a very important rule. And if you do the first 4 right, this one becomes a little bit easier. An emotion is an enemy of smart, thoughtful investing. Every day you can turn on the news or pick up a newspaper and find bad news that may influence the decisions you make with your investments. And the relationship between investing and emotion is very strong. But why? Because in many cases, your family's net worth, retirement, is tied directly to the performance of your accounts. So how do we prevent ourselves from doing the wrong thing at the wrong time, which is, selling low and buying high? And the answer is to, again, focus on what we can control. And the thing that separates good investors from emotional investors is simply the discipline to drown out the noise. Now, 2008, if you guys can remember, was hardly noise. Same with March of 2020 during the beginning of the pandemic in North America. These periods had a huge impact on a lot of people and a huge impact on their life savings, the economy. And during these periods, some investors did panic at the bottom. They thought it was going to go further. They sold their investments. But what happened after that is they didn't get back in the market and they missed out on the rebound. And now after 2008, the following 10 years, if you had just stayed invested, the following 10 years produced some of the greatest returns in the history of the stock market. And unfortunately, not everybody participated in that. The people who didn't drown out the noise and the people who didn't have a properly diversified portfolio were likely the ones that kind of ran for the hills when this happened. Because the truth is, we never really know when a recession is going to hit or how deep it's going to be. But smart, thoughtful investing means sticking to your plans and thinking long term. We're humans. If I see a bear, my reaction is to run away. But if you think about the market and you see a bear market, which is what it's referred to as, rather than running away when the market's down, the best solution is sometimes just doing nothing at all. But again, that's assuming you're already following the first 4 rules. I'm going to pause there before I, for a moment, if anybody has any questions.
I have a question regarding fees.
Yeah.
I guess it's sort of a 2-part question. So like I'm currently investing and I'm just wondering at what point do the fees get taken off? Like, because I don't feel like I see that. So I'm wondering, and then I'm wondering if there's a difference between a management fee and then an MER. So I know it's like a technical question, but I'm wondering if you can comment on that.
I absolutely can. So there's 2 questions in there. One is the structure of the fee. And the other question is kind of why don't I see them? Is that right?
Pretty much, yeah.
Okay, so transparency around fees in Canada has been an ongoing conversation for decades. And the reality is it's kind of murky waters, because unless investors actually take a deep dive into the fact sheets of what they're investing in, you're only going to see a portion of the fee. So there's something called trailing fees or commissions, and then there's something called embedded fees. Now, most investors only know the fee they're paying to their advisor or the bank that represents them or the institution that represents them. But there's also a large part of the fee that's embedded within the fund that goes back to the company managing the fund. And it leads into your next question about investment or like investment management fees and MERs. An MER is the fee you want to look for, because that's more of your all-encompassing fee. So if a mutual fund, I'm not going to pick on any of the banks or anything, but if they're all kind of the same, if one of them sells you a mutual fund, you're probably seeing that bank gets paid around 1%. For you as their client to give you advice, recommendations on the investments. But there's probably about another 1 to 1.5% embedded within the fund that they legally do not have to tell you about. Now, when you first buy the fund, they usually show you a piece of paper that says, here's the fund you're buying. And if you read the fine print, you will find that buried in there, but it's not at the forefront, which is where a lot of companies like us think investors should be more informed about what they're paying. We review portfolios for our clients every day. They have some money with Wealthsimple and maybe they have some money somewhere else. So we give them a review, which is used as an educational tool. Here's what you're paying. Here's how your funds are set up. Now you can go use that information and make an informed decision. And 8 out of 10 times, they had no idea what the fee they were paying was. Does that answer your question?
Sorta. So, like if you say you're a do-it-yourself investor, there wouldn't be that management fee. There would just be an MER.
If you're a do-it-yourself investor, it depends what you buy. So a mutual fund or an ETF will have an MER. Mm-hmm. Basically, that means there's a management fee somewhere within that investment. Mutual funds are typically much higher than ETFs. ETFs are very similar to mutual funds, but they have some different, I don't want to get too far into the weeds on that, but they tend to be much cheaper because they were introduced to track indexes rather than being active funds. But if you're a do-it-yourself investor and you buy a stock in your portfolio, there's not going to be an MER. Only when you're buying like a fund that is managed for you will there be an MER.
Okay, thank you.
Yeah, cool. Anybody else?
Actually I have another question as well.
Yeah.
Still on fees. Aside from the MER fee that you're speaking of, that is taken monthly or yearly, depending on like who you're with, is there a fee that you pay or a percentage that you pay when you put money in or that when you pull money out?
There are some mutual funds that have things called commissions or deferred sales charges. So if you buy a mutual fund that has the acronym DSC attached to it, there's most likely going to be a fee if you want to try and sell that mutual fund. Now, they do have a maturity date where you can sell them without paying that fee, but it is something to be mindful of before selling any of those mutual funds, because those fees can be as high as 5, 6, and 7%. So it's meaningful.
Is that of the total amount you invested, or of your like profits, your return?
The whole amount that you have in that mutual fund.
Wow. Okay.
So again, those are with mutual funds. ETFs don't have those.
Mm-hmm. Okay, great. Thank you.
Yeah, no problem. Anybody else? No? Okay, cool. So just to quickly recap on this slide, I'm listing the 5 rules. Number 1, again, get started, start soon, invest often. There's no magic amount of money to start investing. Setting up automatic deposits, even if it's just a few dollars from every paycheck, is a great way to do this. Number 2, don't pick stocks. We all have a friend whose neighbor's brother's golfing buddy made a fortune doing something, but chasing returns is a really good way to have a negative impact on your portfolio. Buy broad index funds in order to give yourself proper diversification. Number 3, you got to keep your costs low, and just keep in the back of your mind, the golden rule is to try and stay below an all-in fee of 1%, whether that's an MER below 1 or an advisor fee that includes all of the MERs. Just try and keep it below 1%. Number 4, diversify. Don't put all your eggs in one basket. And number 5, tuning out the noise becomes a lot easier once you've kind of followed rules 1 through 4. Follow these 5 rules and you will be in a good position to succeed. Now, to wrap up, I thought I would share a few tips, or kind of the way that we think about getting started. And thoughtful investing includes prioritizing expenses. And it may not always make sense to start right away if there's a few things that you want to do first. So on this slide, I have 6 bubbles. They're going from 1, 2, 3, 4, 5, 6, and I'm going to go through each bubble just as a point, kind of like a waterfall. So number 1, if you have high interest debt, think credit cards or high interest loans, you want to pay that off first. That's bubble number 1. Number 2, you want to think about having an emergency fund. A general rule of thumb is 3 months living expenses, or if you have a family with maybe children, you want to think about having up to 6 months that is more liquid and ready in the event that you need something. And what this does is it allows you to not dip into your investments if something comes up in your life. And what's important there is that there are opportune times to sell investments and there are not opportune times to sell investments. And having that emergency fund will make sure you don't have to sell something at the wrong time. Number 3 is to take advantage of employer matched accounts. If you have a job that the employer is willing to match a portion of your RRSP contribution, absolutely try and do this. It's part of your salary. It's part of your compensation. And if you have the ability to do it, definitely take advantage of it. Number 4, invest in tax sheltered accounts. So these are tax-free savings accounts, RSPs. We get the question often, which do I invest in? And it's not the same for every person. It depends on your level of income. It depends how much savings you have. But at Wealthsimple, we try to help answer this question a lot. I'm on the portfolio management team. We speak to a lot of our clients about portfolio construction, but also about financial planning. And this is a really important question that comes up a lot. And if any of you guys have questions about that, we're happy to help kind of guide you which might be the best place to start. Number 5, paying down low interest debt. So you'll notice we recommend investing before paying down low interest debt. That's things like mortgages. Interest rates are very low right now, and investing is actually producing greater returns. which is why we prioritize things like RSP and TFSAs over that. And number 6,
what would be, what would you consider a low interest debt? Where is the cutoff between high and low, in your opinion?
It depends on what you're comfortable with investing. But, if you look at a balanced type of portfolio that's earning 5 or 6% a year, annualized, if your interest is less than that, then you should be investing, and just paying off your interest kind of as your plan or along with your payment schedule. Now, if you're only comfortable investing in an extremely conservative portfolio that is earning 2 or 3%, but your debt is 3 or 4%, then we would probably recommend paying off that debt first. But things like an RSP have other tax advantages that come into play, like reducing your taxable income for the year and giving you a tax credit. So that we also have to work into the solution.
Great, thank you.
Yeah, no problem. And number 6, additional investing. This is non-registered accounts. So once your RSP and your TFSA are full, then you would open what's called a non-registered or a personal account. Still a great account to be investing in, but you do pay tax along the way. So we want to make sure our RSP and TFSA are full first. And now, where do you go to do this? And I'm listing 3 common options on the slide. We have do-it-yourself, full-service advisor, and Wealthsimple. So a do-it-yourself platform, you are in charge of that account. It has typically extremely low fees, a low starting point, so you don't need a lot of money to start investing. They're usually around $500 or so. But you get no advice and you get no help on account management and kind of understanding which accounts are most beneficial for you. So if you're somebody who likes to manage things your own and has a good understanding of that, it's a great solution. Going with a full service advisor typically has higher fees. So think of your traditional bank channels, brokerages. This would apply to mutual fund dealers, some of the more mom and pop local shops that you may have heard of. They do provide advice. They help you manage your accounts, but they often have higher minimums, and the fees end up being quite significant. At Wealthsimple, we're kind of in between these two. So we do have very low fees. We do provide advice. We help our clients manage their accounts, and we have absolutely no account minimum. You can start with $1. We construct portfolios out of things called ETFs, or exchange traded funds. These are very low cost index funds that are used to track different parts of the market. And we have some exposure in Canada, the United States, Asia, emerging markets, and all across different asset classes as well. So equities and stocks, bonds, there's real estate exposure, gold. So really having a properly diversified portfolio. There are a few more options, I guess, but these 3 represent probably 90 to 95% of the market. And that's all I got. I'm happy. I'll definitely be here for questions. But again, I just want to say thank you guys for having Wealthsimple and myself. We're really excited to be part of the Let's Talk Money series. Hi, Chantal.
Well, thank you.
Hand up?
Oh, Chantal, go up. Go ahead.
Okay. If my investor manager told me I do 5% average, but they charge 2%, is that mean for real I only made barely after the inflation rate of 2%, I make like 3%?
So if they said that to you verbally, I don't know. I wouldn't be able to answer that. Now, I know most advisors are regulated when they report the performance to you, or show it to you on a statement. It is supposed to be net of fees. So if you saw that on a statement, I would be pretty certain that that would be a after fees have been paid number. But if they said that to you verbally, I'm not sure.
And okay, so is that mean like the 2%? If let's say an investment do 2% rate, and I've been charged 2% of management investment fees, does that mean I do 0? Is it the way it calculates, or it's more complex than that?
That's generally it. So if your investment earns 2%, if that's the real rate of return for your investment, but then you get charged 2%, yeah, you're essentially earning 0. And, after inflation, you're actually losing money every year.
Okay.
I know, like mutual funds, they're highly regulated on how they report fees and performance. And on all of the fun facts they show, the performance numbers would be net of fees. But I'm not sure how your advisor would show you that info.
Interesting. Thank you.
Yeah,
that's a great question. That's a good question.
It is a very good question.
Do we have any other questions? Don't be shy.
I have a question. I know you talked a little bit about the TFSA earlier, and I know the TFSA, like we get our yearly limits of our contribution rooms, but I heard that, if you're investing in a TFSA, you can actually make more because whatever you sort of earn on that investment will actually sort of increase your limit. Say you were to take that out and you were in the good, does your limit actually stay as high as what it was when you took your investment out?
Yes, as long as you actually remove it from the account. So as an example, if you put $10,000 in a tax-free savings account, your investment goes from $10,000 to $20,000. If you just sell it and it stays in cash, you haven't actually increased your limit, but you do have that amount in the TFSA. Now, if you put in 10,000, it grows to 20, and you take that money out of the account, you can put 20 back in. Is that what you mean?
Yeah. So not only do you have to sell your holdings, you have to actually take it out.
Yeah, that's right. Basically what it means is any amount of money you withdraw from your TFSA, you can put back in, or you can recontribute that same amount.
Okay.
The contribution limit gets carried over to the next years, let's say, right?
That as well, yeah.
Okay.
A TFSA is an amazing account. It's my favorite account. It's not always the first account people should be funding, but I think TFSAs can become a very meaningful part of somebody's long-term financial plan. And the fact, if the government continues to let us contribute to that account and it continues to be tax-free, and we have to assume it will, or there'd be some sort of grandfathering rule. You think about an account that can grow tax-free for 60 years, and then you don't pay tax on it when you withdraw that money. That's a very exciting proposition.
Mm-hmm. In your opinion, how should someone go about picking which account is right for them?
There's no straightforward answer. It depends on what your goals are. One of the biggest differences between an RRSP and a TFSA, ignoring the tax benefit of each one, an RRSP is more locked in than a TFSA. A TFSA you can access at any time. So you can put money in 2 years later, you can withdraw it, and then you can put that money in a year after that. No problem. But an RRSP, if you put money in, if you want to withdraw those funds, you're going to actually have to pay tax on it. So now all the growth is tax-free along the way, which is wonderful, but you actually pay income tax when you withdraw money from an RRSP. So that's number one. It depends on your goals. What's this money really for? Number two, it depends on things like tax brackets, which you're in. If you're in a high tax bracket, investing to an RSP has more benefit because you're going to save even more money in taxes. If you're in a low tax bracket, maybe a TFSA might make sense to start first.
Awesome. Thank you.
Yeah, of course.
Do we have any more questions?
I have a couple questions. I'm wondering, for Wealthsimple, is there a minimum a minimum age that you can get started at?
We operate off of the age of majority. So with any investment account, you do have to be the age of majority in whichever province you reside. I'm not sure where everybody is. I'm in Ontario, which is 18. Most provinces are 18 or 19 years old.
Okay. And so last week we talked about RDSPs, and I'm wondering, do you guys offer RDSPs, and what other accounts are available through Wealthsimple?
Unfortunately, we do not offer RDSPs. Those are typically offered through bank institutions. Less so. I think some investment firms, like proper investment firms, offer them. But Wealthsimple is technically not a bank. We're an investment management firm. Fingers crossed, one day we'll be a bank. But in Canada, that's a big regulatory battle. But one we're fighting. So outside, unfortunately, we don't offer RDSPs. But outside of that, we offer the majority of accounts you can think of. All registered plans. We have our ESPs for children, personal accounts, corporate accounts. It's pretty much anything you can think of outside of our DSPs.
Okay, thank you.
And maybe one other, a newer type of account we have, it's not an investment account, it's like a high interest savings account. And we opened it up because we talk a lot about having an emergency fund. And we encourage a lot of our clients to make sure they have that. We have something called Wealthsimple Cash, which pays 0.75%. It's zero cost. There's no fees whatsoever. And you earn 0.75% a year for your cash. And I think most banks now are close to zero. So it's actually, even though it's nothing to write home about, it's pretty attractive.
Awesome. Thank you.
Yeah, thank you guys.
I have another question. Did you mention that your organization can review a portfolio that is already with another investment company to give feedback and analysis?
Yes, absolutely. It's something we do very often. Essentially, the way that it works is, we talk about what you're currently doing, the types of investments you have, and then we put together some information that shows how much you're paying, what type of investments you're really invested in. If it is an index mutual fund, we can show you that. And really we use it. It's a tool for, our clients, Canadians, to use just to make, thoughtful decisions on if they're doing the right thing.
Is there any fees attached with that analysis?
No, not at all. And if it's okay with Caleb and Danica, I'm happy to share my contact info.
Yes,
with
for sure.
If they want to
type it in the chat. Yeah, if you want to type it in the chat, that would work too, but you can send it to us and we can circulate it with the material.
Okay, I'll put my email address in the chat, but maybe if I'll send you guys my full contact details and you can circulate it to everyone who attended.
Yeah, for sure. That'd be awesome.
Thank you.
Yeah, of course.
So I have another question.
I like it.
So one thing I've heard often is, it's not about timing the market. It's about your time in the market. And I always wonder, is there a difference to, either putting a bigger lump sum once a year or paying a monthly or biweekly amount into your investment account? I don't know if that makes sense, but I'm curious to see what your thoughts are. Is it better to pay a bigger chunk or smaller chunks, essentially?
This is another A+ question. I should really have this as part of the presentation. So to answer your question, there's two questions. They're actually different from one another. Timing the market versus time in the market, which is a saying in investing and one that we preach all the time. And time in the market is so important. And it's all about rule number 5, ignoring the noise. As long as you stay invested, you will have a good experience as an investor. Now, timing the market is very difficult to do because in order to get it right, just one time, you have to get it right twice because you got to know when to get out and you got to know when to get back in. And a really famous fund manager, I believe it was Peter Lynch, said people lose more money waiting on the sidelines than they do in the downturn itself. So if you say, okay, we're at the top of the market, I'm going to cash. Like I've got my crystal ball is on fire today and I'm going to cash. But you're wrong. And the market goes up for 3 more years, but then it crashes. But it's probably still above where you pulled out. So you've already lost out on 3 years worth of returns. Whereas if you just stayed invested, you'd be in a much better position. And the second part of your question, sorry, does that? I think your first.
Yes, that makes sense.
Yeah, it's more like
Can I actually add something there? I was reading an article this morning actually exactly about that question, and the article looked at historical data for like if you were trying to beat the market by cashing out, and if you would have missed just 10 of the market's best days in the past 20 years, I think it was 23 years. I think it was 1997. If you would have missed just 10 of the best days, you would have cut your returns by more than 70%. You would have lost over 70% of value in your portfolio from instead of just holding all the way through. If you would have just missed 10 of the days, which is really interesting.
Yeah, it's a great point, and there's a ton of research on this. And what Caleb's talking about is whenever you have the bottom of the market in March, in the pandemic in 2020, it was March 26th was the bottom of the market. And to Caleb's point, the next 2 weeks were like almost the 2 best weeks in the history of investing. Mm-hmm. So if you went to cash, but you missed those 2 weeks, you've already lost money.
You would have lost significantly more money.
Yeah. And I call that permanent loss of capital. Because, if you just held on, you'd be in a better position. Now, your second question about it's something we refer to as dollar cost averaging, where if I just invest my money on January 1st, I know I'm going to invest $10,000 this year. I either put it in on January 1st or I put $800 in on the 1st of every month. And there's a good Charles Schwab article about this. That's like Tammy Timer, Rotten Rosie, all these people who invest based on different scenarios, and the people who just invest when they have the money and the people who dollar cost average have almost the same experience over the long term. And they did this over, a 20 or 30 year period, not 1 or 2 years. So a benefit to dollar cost averaging or investing every month versus in a lump sum is that it can reduce your volatility or your expected outcome of returns. because you're investing at a variety of different entry points. Whereas if you invest on January 1st and January 2nd, the market starts to pull back for 2 weeks, you may be upset. But as long as you stay invested, chances are you're going to have a similar experience as if you invested kind of all along the way.
That's neat to know, though. But
yeah,
it doesn't sound like there's a right or wrong way to do it. It's more about your own emotional stability when it comes to seeing your investment drop.
Absolutely. And if it's sometimes a recommendation we'll make to people who, if they have a lump sum, whether that's they've just been in cash, or maybe there's an inheritance, or for whatever reason they come across a large sum of money. From that emotional point of view, dollar cost averaging or starting with a conservative portfolio and getting more aggressive over time is just a way to get more comfortable with investing, to understand the way the market moves, kind of rather than jumping in head first.
Great, thank you.
Good question, Danica. Any other questions before we wrap this up? This has been probably one of my favorite sessions. This has been super interesting.
Good.
I do have a last question.
Go ahead.
Do you have
worries. Go ahead.
any advice on we heard often that it's good to keep the money in and not touching it, even though it decreased. But sometime in my readings, I saw that they start saying that sometime you have to take the decision because clearly it's not good to leave the money there. So do you have any tips or advice or comments on when it would be a good time thinking of not continuing in the fund that you invest in?
Yeah, and it depends on the fund. So the way that I would answer that is, first of all, what type of investment is it? Because a stock can go to zero. It happens all the time. So if you have all your money in one stock, it can go to zero. And if your investment thesis on that investment changes, then yes, you should be willing to sell it. Now, we invest a different way. We have passive portfolios that represent huge chunks of the stock market, and we have confidence that the stock market as a whole is not going to go to zero. You can look over the past 130 years, and the market just goes up and to the right. Like if you look at a chart of 130 years, it's almost a straight line up and to the right. Now, along the way, there have been huge dips if you zoom in on specific time periods, Chantal. But I would say, do you have a diversified portfolio? Are your costs low? Are you spreading your eggs across many baskets? And if you've kind of checked yes to all of those questions, I would say, rule number 5, ignore the noise. Now, if it's not diversified, if it has high fees, if these boxes are not checked, then yeah, I think you should have a sell discipline or, a thesis as to why you would want to sell an investment.
Just looking at the time, we can have one more question if anyone has a burning question. If not, we'll just go ahead and wrap up.
I think that's it. I think you answered all our questions.
Very
awesome.
Good.
To learn more about the CNIB National Youth Council, visit cnib.ca/NYC.